The countdown is on. Everything you need to get the edge at the end of the market day. This is The Close.
Volatility resets higher, stocks reset lower. Live from Studio 2 here at Bloomberg headquarters in New York, I'm Romaine Bostick.
I'm Alex Steele. Where's the direction this week so far?
I don't know. It's kind of nowhere right now, but that could change in the next couple of days.
That's right. Let's take a look at where nowhere is, because for this chart, I wanted to draw an intraday of the S&P just because the moves are so interesting. It looks like we're just repeating the same kind of drop and rebound, drop and rebound, drop and rebound all throughout the trading session, but those drops get a little bit less. I have no idea what this means. I even asked Abigail Doodle, our resident chart expert. We're just basically looking at a lot of uncertainty, like the directionlessness of the market remain. To your point, we got to kick it until Wednesday and then Friday.
Yeah, I think what you're looking at there is maybe the ashes of that big sell-off that we had to start the month. And when we look through those ashes of the past couple of weeks, Goldman tactical specialist Scott Rubner saying that massive sell-off was largely one of systematic funds unwinding positions. That's a viewpoint shared by Bloomberg Intelligence, citing the mismatch between the VIX and spreads on corporate bonds. Tony DeSpirito over at BlackRock also in the same camp, saying that the recent tumult really had more to do with market internals rather than corporate fundamentals.
So I think it's very much technical. Think about how we went into this. If you looked at June 30th, if you looked at a cap-weighted measure of momentum, it was in the 5th percentile over the last 12 months. That's extreme positioning.
And that extreme positioning has the S&P still down 6% from its record high, but holding above that 200-day moving average, an encouraging sign that Michael Hartnett over at BFA says means that the economic soft landing narrative hasn't quite been broken, at least not for large cap stocks. As for small cap stocks, well, the Russell 2000 continuing its slump, underperforming the S&P for the 8th time now in the past 10 sessions. Traders actually pulled $2.6 billion out of the IWM ETF in the past week. That was the most in almost 3 years. Meanwhile, JP Morgan's trading desk saying that if economic data this week is favorable, it could restore traders' confidence in small and large caps alike. Or maybe it could break it. U.S. producer price data out on Tuesday. Alex, CPI on Wednesday. Retail sales Thursday. And, of course, we get those UMich sentiment numbers on Friday.
I love me UMich. I'm really looking forward to that. So
you just like to say UMich.
I do like to say UMich. All right, Joanne Shu's also really great. So Romaine was talking about Goldman Sachs and sort of the tactical selling. And this comes from Scott Rubner's note over at Goldman Sachs. And I feel like it's a really interesting way of looking at things. So the white line is the systemic funds. So volatility controlled, risk parities, CTAs. When you have momentum sort of begetting momentum, then they have to sell. And then you have the pink line, which is the S&P. What's interesting here is if you take a look at what happened over the last week or so, you have the systemic funds drastically selling more than the S&P fell. Now, the takeaway there from Scott Rubner is that they've oversold a lot. They overshot to the downside, so that maybe now we'll see some stability, maybe a little bit more to go, but we'll see some stability, and that's why he's a tactical buy in the first 2 weeks of September. But, Romaine, that does not last. Then he says the last 2 weeks of September are seasonally the worst of the year. So that tactical bull trade is what Scott Rubner is going to be basing his call on.
Yeah, and that chart really illustrates, I guess, the data behind that call. Sherry Paul joining us right now live on set, Senior Portfolio Manager at Morgan Stanley Private Wealth Management, helping kick us off to the close here on this Monday afternoon. How are you?
I'm great. How are you?
I'm great as well, but I'm going to start off with sort of a Finance 101 question here.
Lay it
Just
on
kind
me.
of explain the difference, because a lot of people are talking about the sell-off that we had over the last couple of weeks as being more technical rather than fundamental. Just kind of explain the difference.
Well, the basic difference is one has nothing to do with earnings, and the stock market cares about earnings. And so when money is moving around the globe and unwinding in different hedges, it has nothing to do with earnings, which is why we saw the bounce back so quickly. And I think the gift in Monday was an opportunity for investors to do kind of a mind and a money gut check in terms of how well structured portfolios are for the inevitability of volatility going forward. And if you haven't taken action on that right now, then you're missing the boat, because that is the gift of Monday, in my opinion.
Do a lot of your clients and the other folks you interact with, did they see that as a gift, or were they maybe a little bit more concerned about that?
Well, I think whenever you see sort of a downdraft like that, people go back to the last worst moment that they recall, which is the pandemic. Like, I still think that people are in sort of PTSD mode whenever we get sort sort of a downdraft and people are waiting for a shoe to drop. But as I've said then, and I'll say it again now, that things typically turn out better than people think, and you're better off positioning your portfolio from an opportunity set, because that's the nature of investing. And right now there's tremendous opportunity in the market for people to right size or course correct if they've been, for example, too much in cash or in the wrong part of the curve of the bond market, or they haven't taken profits, where they've made tons of money in tech and things like that.
So where do you want to buy if you want to reallocate and you want to buy the dip? Where do you do it?
Well, if you're sitting in cash, which is, a declining value based on what we think are going to happen with interest rates, and you're trying to fund like a brand new cash portfolio, I'd go right down the middle. You want to be 4 to 7 years within the bond curve. You're going to lock in that great yield. You definitely want to be owning utilities and staples for rising dividends and the security of income. I believe every portfolio should be earning money at all times. And then for the innovation kicker, we're not too long in the tooth yet in tech. And I think that people have underplayed the value of this moment of innovation that we're in. And I've been really, I think, on the forefront of that for the past few years. So I wouldn't be afraid to go into the growth areas of the market as well.
What do you think is then going to drive the price action going forward? Is it going to be the data and the economic fundamentals, which is exactly kind of what we were talking it not being before? Or is it going to be technical and sort of liquidity? What do you think?
Well, I think it's all of the above. But there's a third leg to the stool, which is I always want to go back to earnings, right? And so what will drive earnings are both productivity enhancing, cost cutting, innovation, and capital investment. So that's sort of hedge number one, and that's why we get such a narrow sector performance within the S&P right now, because certain sectors are going to deploy that more rapidly than others. So that would be step number one. And just to remind, viewers and individual investors that, economics is a rearview mirror, right? So I always talk about that we're operating in parallel universes in different time zones. So investing in the stock market is a forward exercise, whereas confirmation of what's happened in the past is what the data is showing us, but it's typically 6 months in arrears. So as a portfolio manager, I'm always pivoting people into forward thinking, and I think then you just really want to focus on earnings and stay out of the mud of political and policy volatility, which often gets people stuck.
Can you do that, though? I
mean,
there's always the old joke where, somebody says, I don't do politics, and it's like, oh, well, politics is doing you. and I feel like for investors, that's got to be the same to a certain extent. I know there's not always a direct correlation.
I'm getting a T-shirt made. I want a T-shirt.
It's not mine, so feel free to see it.
Yeah. I think that it takes a tremendous amount of mental strength, and we all have to be honest about that it's getting more and more challenging. But the reality is that the opportunity set is just too good going forward, and what I believe that we are in a secular bull market driven by innovation, where we will have these cyclical setbacks, but politics and policy are volatility unless they directly impact earnings. So, keep your eye on the prize.
Keeping your eye on the prize, though, and everything you mentioned is true, and we've seen that historically play out. But of course, as you kind of allude to as well, it's never a straight line. There's always these bumps in between. Right. And I think that's what people are trying to figure out is how much longer are we going to see these types of major bumps before we finally get a little bit more of that tail to the upside.
Well, I'm so glad you brought that up, because you're right that people think that things go up in a straight line and they don't. So the answer is we will always have them. Right? This is why the compounding rate of return concept for balanced portfolio investing is so enduring. We were talking here a year and a half ago where it was out in the market that the diversified portfolio is dead and the bond market has no value, and now it's a completely reverse narrative. And so for investors that want to make money, it's the power of compounding returns. And right now, we are in a moment of risk-adjusted innovation, unlike the early days of the internet, which we've talked about in the past, that these were companies that didn't have earnings. Here we're installing tech in proven business models that will improve profitability. And I think it's just too powerful to be frightened out of the market because of a technical unwind.
Yeah, definitely a certain, much different complexion to this tech rally than what we saw about, was it that long ago? I was about to say 20 years ago. Then I was like, it was longer than that.
I know.
I'm old, Sherry.
Hey, I'm right there with you. Let's get another mug made.
I don't know, guys. I was 3, so whatever.
All right, Sherry Paul, Senior Portfolio Manager over at Morgan Stanley Private Wealth Management, kicking us off to the close here on this Monday afternoon. A focus on how to invest in equities, a focus on how to invest in fixed income. Sonali Pier over at Pimco saying it's still a good time to put your money to work. She'll be joining us in just a moment.
All right, plus you got shares of Starbucks brewing its way higher. Activist investment firm Starboard Value reportedly taking a sizable stake in the coffee chain. We're going to break down what that means for the company.
And a closer look at those corporate fundamentals as earnings continue to roll on. Home Depot scheduled to report tomorrow, a preview of what investors should expect. All that and more coming up in a bit. This is The Close on Bloomberg.
Season is here.
You're seeing back-to-back billion-dollar-plus quarters.
The forward indicators were so positive.
Bloomberg is first to break the numbers.
Texas Instruments out, folks.
Goldman Sachs taking a look at Mattel.
There is something for everybody.
With the smartest insights.
People are whitewashing AI.
Wallets are under pressure.
We are committed to EVs. They're going to happen.
Earnings season in full swing.
We will have full and instant analysis.
Continuing coverage on Bloomberg. Context changes everything.
Shares of KeyCorp are up by almost 9% after Scotiabank agreeing to buy nearly 15% stake in the regional bank for about $2.8 billion. Bloomberg's Matt Monks joins us now, who used to be in the M&A team, is now moonlighting in the finance team. But this is like a perfect example for both of your worlds. What did you make of this? Is this going to be like an eventual takeout by Scotiabank?
I thought this was weird. This is what you see when you don't see normal bank M&A. In a normal bank M&A environment, Scotiabank, which has ambitions to grow internationally, would simply buy KeyCorp. Why is it not doing that? Well, it's nervous that if it buys it, it will two things. The deal might get rejected, and it's going to have to eat a big loss on its bond portfolio. So what is it doing instead? It's just taking a 15% stake. What does this allow KeyCorp to do? KeyCorp is going to use this money, about half of it, to eat the losses from selling from selling bonds and rolling it over into higher yielding investments. It's like a real common thing going on right now. A bunch of banks have these unrealized losses in their bond portfolios.
15%, is that where it stops here? I mean, this is a 5-year deal effectively, and there's been a lot of chatter that when that expires, this could become a full-on acquisition.
It could. Now, if you look closely at what they said in the press release today and in their commentary, they said it gives them optionality. But I think, it's a win-win for them either way, right? So they get into the States, they get some exposure into the States. It's going to be a good investment for them. They're going to make money on it. And then is there a chance for them to buy the other 85%? Sure, maybe. Will they? Who knows?
At 15%, do regulators care?
Yes. So they're buying it at 5%, and then they need approval from the Federal Reserve to buy that extra 10%. And 14.9%, that tends to be the magic number where regulators feel comfortable having other entities buy into a bank without, owning the whole thing.
Is there anything we can read into this about the health, not just of KeyCorp, but of the regional banks overall?
Well, this does give you a little insight into how some banks can get this stuff off their books, right? If you can find someone that's willing to come in, take a big chunk of you, give you some money, you can eat those losses, roll them over into better yielding securities, boost your net interest income. So there is a way through. Now, the question is, do you find private equity to do this? Are there other international banks willing to do this? So it's a cool little transaction.
Because we have like 4,000 banks, right? Like we're really over banks.
Yeah, there's 4,000 banks, and not only that, there's like 20 like mid-sized banks that are really big. And if you just go through the top 15 and look at their unrealized losses in their bond portfolios, they're huge, multi-billion-dollar losses on pretty much all of them.
Right.
All right.
No, go ahead.
All right, Matthew Monks. No, I'm just saying goodbye to Matthew. Matthew Monks there. A great story here on the terminal here about Scotiabank and its deal to buy about 15% of the U.S. regional bank, KeyCorp. And this kind of gets us back, I guess, to that regional bank crises. I put that in quotation marks that we had in March of last year here, and whether we actually sort of resolved all of those issues, and clearly not. I mean, just based on this deal, there's obviously still a lot of this junk on the books. But the question is, how much longer does it take to get this sort of sorted out?
Well, and also just the idea of like 4,000 of these banks.
Yeah.
So if the total M&A world, we're not going to be able to support like another bank buying 100% of another bank, where does that wind up leaving us? So, are we going to have all these weird investments from mid-tier to smaller tier banks? Is that okay? Does that work? I don't know.
Well, that gets to a question. I have no idea what the hardcore regulatory line on this is, but politically, we know there's been a lot of advocates here saying that 4,000 banks actually isn't enough, right? There's this idea here that the bigger banks don't do community-based lending, and there aren't enough community-based lenders out there. So there are some people that advocate don't allow these mergers, allow these banks to continue on their own. And I don't know if that's the best course of action, but that's certainly what they're arguing for.
I don't know. It's going to be really interesting, particularly with the election. Like we're talking about the election risk coming up if you want to try to ignore it, like Sherry does, sure. but at some point you can't.
Yeah, absolutely. All right, a lot more coming up here on the big program. We're going to take a closer look at shares of Starbucks inching higher here in the cash trade. This after activist firm Elliott was said to be in the home stretch of finally getting a seat on Starbucks board of directors. All that and more coming up in a second. This is The Close on Bloomberg. All right, time now for our top calls. The big movers on the back of analyst recommendations, and we start off today with Qualcomm. A downgrade to peer perform over at Wolfe Research amid heightened concern about the company's prolonged relevance in supplying connectivity chips to smartphone makers. The analyst saying Apple's plans to develop its own components for the iPhone creates a headwind that's not fully in estimates for Qualcomm, which gets 27% of its revenue from Apple. Shares down about 1% on the day. Next up, Coherent, the maker of lasers, optics, and other materials for semiconductor manufacturing, upgraded to buy at Bank of America. The analyst says the market's desire for AI optical devices can drive growth. He also credits the new CEO, who is expected to unveil operational improvements and expand gross margins. Those shares up by about 3%, 4% on the day. And finally, Take-Two Interactive, leveling up to buy from hold over at HSBC, a price target going to 179 from 154, and an analyst citing an improved outlook for mobile gaming in the wake of those solid first quarter results. He also cites encouraging guidance for the anticipated release of Grand Theft Auto 6. Those shares higher by more than 2%, and those are some of our talk calls. Now, let's turn to one of the most talked about movers on the day, and that is Starbucks. Bloomberg reporting that the coffee chain is in talks with Elliott Investment Management for a seat on its board of directors. Sources telling us that Elliott also wants Starbucks to review its business in China. Our next guest recently turned into a fireside chat with the Starbucks CFO. Let's bring in Andy Barish. He's the managing director of equity research over at Jefferies. He's got a hold rating on the shares. All right, Andy, it does look like, at least based on the reporting, that Elliott might actually finally get a more formal say in what's going on at Starbucks. Based on the call that you had a chance to listen in on here, how much do you think could change if that does happen?
Yeah, it's a good question, and thanks for having me on. Obviously, the company's not talking specifically about any of their discussions with any of their shareholders, and there's also some headlines around another activist investor. I mean, clearly, there are some things that aren't going well at Starbucks right now, and I think this is a situation that kind of is ripe for a different viewpoint. And I think that's what Elliott and, maybe others are trying to bring to, bring to the situation and to the board.
Well, let me turn that question around on you, Andrew. I mean, you're obviously the expert in this space here. When you look at the performance of Starbucks over the last few quarters, really over the last couple of years here, do you think the improvements that would help, obviously, with the stock and help with corporate fundamentals, is that more based on what they're offering in those stores in terms of products, or is this more about corporate reorganization and corporate streamlining?
Well, with the new CEO, a relatively new CEO, the focus has been on innovation and also then in the backdrop, also on efficiencies and productivity and supply chain saves. And I think they're doing a good job on the latter. The former is where it seems to be missing with the customer. And there has been a lot of new platforms launched here in 2024, from lavender to spicy to pearls, which is like boba, to now an energy drink. And they have attracted some early interest and trial, but it just doesn't seem like they're hitting home with the consumer and generating repeat business and frequency. And I think that is what, Starbucks kind of needs to go after. And that's going to take a multifaceted approach. But there does seem to be something that's missing a little bit, on the innovation side of things, in our opinion.
The other side is going to be China and those strategic partnerships in China. What does that mean? What does that look like?
Yeah, that definitely came up and, has been, well followed since the earnings call a couple of weeks ago. I actually think it means that they are looking to continue to grow in China. I think thinking at this point it's very early on in any kind of discussions, but I think they are looking to maintain their ownership of that business. Again, that could always change, but I think they view the short-term pressures as just that there is a long-term opportunity to be the premium player in that very large market, as maybe there's some shakeout that occurs over the next couple of years, given the huge number of competitive players that are growing and entering China, as we speak.
So what's the proposition then for an investor? Is it sort of like hold on to it for a little bit because the issues will get fixed, but it's down along the road a little bit, or is it you just need to wait?
Yeah, I'm at a hold rating just because I do think whatever's going to happen, whether it's in conjunction with the activists or the company kind of figuring some things out, is going to take a little bit of time. And I think in the near term, the U.S. and China same-store sales are really the KPIs that matter most for the stock, and I just don't see a near-term improvement, coming in either one of those. So that's why we think it's a hold right now. It has come back quite a bit, but is starting to find some valuation support here.
Do you think, Andy, though, that they could sort of get their mojo back in China, or is that kind of a lost cause?
I think it's going to take a while, just given some of the recent pressures and some of the average unit volumes that they've been showing in China. I know it's a different cost structure over there, but it just feels like that business is, is having some real issues and will take a shakeout in the broader market and probably an improvement in the economy over there to, really propel that business back to anywhere close to what it was in pre-COVID days.
All right, Andrew, thanks a lot. Super appreciated. Andrew Barish joining us over at Jefferies. I, for one, cannot live without my Americano half-calf almond milk stevia latte. Anyway, sticking with some fast casual restaurants, you got shares of Yum brand down by about 1%. Here's the deal, Romaine. KFC expanding its $5 value menu. This is it. QSR's looking for the value play.
Yeah, which, if you remember back in the day, they were kind of always a value play.
Totally.
And then somehow, I don't know, they just started migrating into premium style products, even though I'm not sure the quality was actually premium. But I guess this is good. I mean, when you listen to the commentary we got from the CEO of the Yum Brands, really just talking about how people are just stretched, and they're seeing that in the tickets, smaller tickets, so they got to do something, right?
I think you were off that day, but one of our camera producers had like a regular McDonald's meal, and it cost him $17.
Yeah, I was right here. I asked him about that.
Oh,
but it
there.
gets
You were
back
here
to the
for that,
idea.
yeah.
But it gets to this idea here about like how low can they really go, right? At some point, it's like the value proposition to the consumer ends up eating into your own margin. So where's that balance?
As long as you get the top line. If you get enough people in the store to do it, maybe that works out okay. That's the fine line, really. All right, coming up, we're going to talk to Sonali Pier, a Bloomberg portfolio manager at Pimco, giving us her thoughts on the fixed income market. We're going to break that down next. This is The Close on Bloomberg.
Just about 3:30 p.m. here in New York. This is the countdown to the close. I'm Romaine Bostick.
And I'm Alex Steele. So I was really struck by Michelle Bowman over the weekend talking about monetary policy.
Yeah,
and
it's
saying
good to see she's working through the weekend, though.
Yeah, she is working through the weekend. I will remain cautious in my approach to considering adjustments to the current stance of policy. That, to me, is not a Federal Reserve that wants to move quickly or even an intermediate cut.
And it gets to the idea, though, who's really going to be making this decision? Is it the Fed or is it really going to be the markets? And I mean, obviously, ultimately, it's the Fed. But we saw this last time. The last time when they finally started that whole rate hiking cycle, it was the market that was really driving that conversation. And even the pause, what was it, over a year ago now, July of last year? That was also kind of driven by the market. So you wonder if the market will get it right this time, too.
Or is it the data? We got retail sales this week, the UMISH, which you know I love, and then also CPI. So our next guest says it's still a good time to put money to work, but investors need to pick the right spots. So base case is still for a soft landing, but with fatter tails. So here in studio with more on this is Sonali Pier, Pimco portfolio manager, focusing on multi-sector credit. So good opportunities. Where are they? What do you mean by that?
Yeah, so there's clearly a lot of volatility, but this is still a great time for fixed income in particular. Between the fact that we are looking at potential rate cuts, it's a good time to move out of cash, even though there is some volatility out there. and get into fixed income and really be able to benefit from the capital appreciation when we get those cuts. But on the other side, with equities, there's a lot of volatility, whether it's geopolitical, whether it's politics here in the U.S., whether it's some concerns around unemployment ticking up, and that could certainly disproportionately affect the equity market.
So to that point, a lot was made by the VIX jumping to 65 and the corporate bond spread not blowing out to the same extent that we might have expected. Why was that?
Yeah, fixed income has held in pretty well, and especially the credit markets when you look at the kind of volatility we saw in both the VIX, equity markets and the like. But I think part of the reason it's holding in so well is that level of starting yield generates a fair amount of income. And from an investor perspective, that income is quite attractive. When you look at it from a historical perspective, it's generating, yields that are nearly the 80th percentile. And all the while, we still don't expect defaults to pick up in a material way. So dispersion's high. There's a lot of opportunity to kind of get active and get selective within these markets.
What's still been driving Treasury yields down, though? I mean, is that really about economic conditions, or is this just kind of front-running where people think the Fed is going to go?
I think what we saw on Monday was a little bit of fear, right? As you saw what happened overnight in Japan, and as a result, there was this flight to quality. But I think the market's gotten a little ahead of the Fed at this point, and so again, while we do expect cuts, exactly. We've seen this before, where the market gets ahead and then has to readjust a bit. But I would say September is probably a live meeting.
I know you're primarily focused on fixed income and credit, but when you look at the tea leaves in the fixed income credit space, is that sort of singing the same song as what we're seeing in the equity space, or are we going to start to see more of a divergence in the outlook on equity investors versus fixed income investors?
Equities have had a strong run, and it's been tempting to sort of go in and follow that. But I think the reality of where we are today, and with the volatility that's possible, and like we saw on last Monday, fixed income tends to become that sweet spot of where you can get the upside of, in a multi-sector context of over 7.5% yield, and yet have capital appreciation if we have cuts. And so you have some upside to that, and clearly some downside protection. So, from our perspective, fixed income is still looking quite attractive. Although, there is certainly volatility ahead,
sure.
The starting level of yield can cushion some of that potential spread widening down the line.
Well, then to that point, I was reflecting back on the record issuance of investment grade that we did see last week once things calmed down for a hot minute. You think that the yields will compensate for the flood of supply that we see when things calm down?
I think that highlights also the conundrum from the issuer's perspective, which is, it's better to get financing when you need it, and rather than trying to time it and be so precise. And so, what I would expect, as long as we don't have the same type of high levels of volatility and we've come back in, that we will see issuance. And, we've kicked off this Monday also with a fair amount of investment grade issuance and some announcements in high yield and loans as well.
So exogenous shocks, what are you paying more attention to? Is it sort of the U.S. election? Is it geopolitical risks? I mean, oil today spiking by 4%. There's something happening here. What do you pay more attention to? Or none?
So, I think as fixed income investors, we're kind of always paying attention to all of it.
You're always
exactly.
Scared. We get you.
But I do think the reality of what could really change things in a dramatic way would be more the geopolitical risks. Because I think on the political side, while at Pimco we make our portfolios kind of stand the test of time and really make sure we're looking through the scenario analysis. So it's robust not just for one scenario or a base case, but through, whether it's a downturn or a surprise on the upside. But the real risks where you can get some sort of binary movements really would be around geopolitics. I'm
going to ask you a kind of a stupid question, and it kind of goes to the chart we were just showing, which kind of shows the blowout in spreads. And of course, they were all correlated. The most recent ones were correlated with the recessions that we went through, including the pandemic. How much sort of foresight do you get of that when it's coming? Is it sort of an immediate thing where you just kind of wake up one day and everything's blow out? Or do you sort of get a run up of weeks or even months where you could kind of see that spread widening occurring?
Yeah, it's quite interesting too right now with the Fed about to cut, and historically we haven't been able to get out of that type of situation with the soft landing, and yet that is kind of the base case. So we're sort of always aware of those tails, and in terms of trying to forecast where there could, I would say at the moment we don't see a singular excess that's likely to sort of burst. It's much more around the fact that we could see some concerns around politics, geopolitics, growth, and that can over time. And so, just like the Fed, we're also watching the data closely to see if there's some indications.
Do the elections matter that much? I know equity investors and strategists always say, at least for equities, at least in the short term, really it doesn't have a whole lot of impact. What about in the fixed income space?
Yeah, in the fixed income space, where we're most focused on is obviously, any sort of sweep would have a bigger impact than a divided Congress. But, as I mentioned, since we want the portfolio to be able to perform regardless, what we're often looking at is kind of under the hood. What's the next level of ramifications? And so, for example, areas where we do expect to see policy differences depending on who's in power would be energy, healthcare, financials. And so that's kind of where we're continue to refine positioning and make sure we're kind of being able to capture that upside and have downside protection at the same time.
So what are the favorite sectors right now in corporate credit that you have?
Yeah, so in corporate credit, especially in investment grade, we do prefer financials over non-financials, given the fact that they're serial issuance, they're trading wider than non-financials, and so there's some opportunity there. Within high yield, looking at more of the defensive credits, where the cash flows are a bit more predictable than, say, in wireline retail, where you've got a lot of cyclical headwinds.
All right, thanks so much. We really appreciate it. It was wonderful to have you here, Sonali Pier, portfolio manager, focusing on multi-sector credit over at Pimco. So much uncertainty, though. Let's be honest, Romain. Anywhere you look, it's hard to know where to put it.
Yeah, and it gets to this idea too. I think that was partly when you kind of had all that erraticism in Scott Rubner's latest note here. Things will be great for 2 weeks and bad and that. Yeah. And it gets to the idea of not only the earnings season, but of course also the election cycle as well. Of course, everyone is still focused on the big tech trade and the AI trade that remains in the spotlight, particularly with some of the moves we're seeing today in NVIDIA and Lumen. We're going to take a closer look at those stocks in our Stock of the Hour. That's coming up next. This is The Close on Bloomberg. All right, it's time now for our Stock of the Hour, a closer look at AI as we watch shares of NVIDIA and Lumen. NVIDIA trying to fight against its bear market, while Lumen plunging more than 15% here on the day. Abigail Doolittle joining us right now for more. A 16% drop on Lumen is huge, Abigail, the worst day since August 8th, which was last week. It gets to a point, though, we're looking at two incredibly volatile stocks in NVIDIA and Lumen, obviously moving in opposite directions. There's a lot of concern here about just how much longer this AI trade has to go. So let's start off first with Lumen.
Okay.
And why they're down so much. Is this just simply a function of the run-up?
I think that's a big piece of it, because between the beginning of July and now, or actually the peak just last week, this stock up more than 700%. So, and this has to do with, of course, with their deal with Microsoft. They basically will be connecting Microsoft's data centers using Corning fiber optics. So that's their AI role. So, you have this massive move higher on that. Now you have the short interest coming out, but big moves. That points to not a lot of information, more speculation to some degree. Some people who made money off of that massive move higher, they're now kind of cashing in. So I would say that's the Lumen side of things. In terms of NVIDIA, and this is really going to be not just NVIDIA, this is going to be the whole market. I think the actual date is August 28th when they report. That is going to be the talk of the town, that could overshadow the Fed, quite frankly. And in terms of the numbers, this is really interesting because for any other stock, this would be phenomenal. So for the July quarter, the top line growth is expected to be 112%. For the bottom line, it's expected to be 154%. Massive growth, massive numbers. That said, the quarter before, it was 262% growth and 585% growth. So from a sequential standpoint, you actually have this massive slowdown. And for people who have ran this stock up, at one point 180% on the year at one point to the peak, that's going to matter. It sounds sort of silly in a way, but that's what they're buying off of. If they miss that in any way, they basically have to beat that in the way that they have, so that the growth remains huge.
Here's my thing: with hyperscalers still spending billions, and no hyperscaler wants to be the first one to back off on that. I don't understand how companies that make those chips are eventually going to lose. Maybe the valuation proposition is different, or it doesn't have to be, above all its moving averages aggressively, but still.
Well, some piece of it could be actually we're waiting for this new chip of theirs to come out, the GB200, the Blackwell chips. Now, there is very clearly a lot of demand from them based on the Supermicro computer results and the fact that they were ordering their current chips. But if there's any kind of a delay with that chip, that could be a piece of concern. But I think it's more just like the stock. It was $500 billion at the beginning of last year. At one point, not so long ago, it was greater than $3 trillion and the most valuable company. I think that's the bigger piece. I don't think anybody's questioning that their business is strong, but is it as robust as this stock has been suggesting?
Well, last time I checked, it's still a relative monopoly, right? I mean, there aren't too many places. There's only one other place you can go to get a chip this sophisticated, and that company can't pump them out the way NVIDIA can.
Is that AMD that you're talking about, or
ARM?
Or ARM, And ARM, they've had issues in terms of exactly the production is a little bit disappointing for folks, but.
And look, that'll change. We all know this will change at some point. NVIDIA will have a more formidable competitor, but investors, of course, seem to be all on board because, like I said, I mean, where else are you going to get these things right now? Going to have to leave it there, Abigail. Abigail Doolittle there with our stock of the hour. Closer look at shares of NVIDIA and shares of Lumen moving in opposite directions. Here, Alex, with the market also looking really soft here as we get closer to the closing bell.
Honestly, that intraday dip of the S&P is one of the weirdest things I've ever seen. It's like the same U, but just gets less and less every time. I don't know what that tells me. It's like the volume is super light. It doesn't feel like a lot of people came back to work today, except for us.
And not a lot of conviction in the buying. But of course, we get PPI tomorrow, CPI the next day, and retail sales on that, and then a couple of big earnings in between that. So we do have a few catalysts here that can move the market.
Yeah, you have to wonder, though, is it really going to be about NVIDIA and Jackson Hole? All right, coming up, we're going to count you down, though, to the closing bells with Jonathan Krinsky, a chief market technician at BTIG, coming up on the close.
The reality is that the opportunity set is just too good going forward, and what I believe that we are in a secular bull market driven by innovation.
Sherry Paul over at Morgan Stanley Private Wealth Management. She kicked us off to the close just about 50 minutes ago. Romaine Bostic alongside Alex Steele. 10 minutes until we get those bells, Alex, and it's not looking good.
I'm having a hard time getting excited about today, I have to be honest. Volume is still super light. Where it looks like we're turning to the downside here. The Russell's off by almost a full 1 percentage point. The Nasdaq barely holding on to any kind of positive territory. But what's the signal here? What's really going to move markets until we get something firmer from the economic data or from NVIDIA, really?
Yeah, we should get a little bit of that later this week with the inflation prints, retail sales data, as well as some earnings out of the retailers. Right now, looking at a 10-year still firmly camped out below 4%, 3.9 and change right now. Your 2-year just holding at the line at 4%. Bitcoin trying to rebound here, and the VIX remains slightly elevated, though a far cry from that big spike that we saw last week. Jonathan Krinsky joining us right now, chief market technician over at BTIG. With about 9 minutes until we get to the closing bells. And Jonathan, all everybody wants to talk about is that big sell-off that we had to start out the month of August, and the idea that that was much more technical of a sell-off than it was fundamental. When you look at the technicals, do you find credence to that argument?
Look, I think heading into that, you can always look back and there were, there's some obvious warning signs. One of them was the fact that the consumer broadly, the consumer stocks were showing relative weakness, particularly on an equal weight basis. Equal weight consumer relative to the S&P had been trending lower for several months. And then we had, really it was an issue of complacency in the sense that into the July peak, there was very little interest in put buying. For a lot of reasons that's what happens to markets, right? They grind up, they kind of bore you to death. Nobody wants puts, and that's when you need them. So, I think fast forward to the present, though, what we've been telling clients is we saw, enough capitulation last Monday to get a tradable bounce. I think that's largely run its course. So, we're suggesting anything north of 5,400 on the S&P. You probably want to look to fade that in anticipation of a bit of a move lower and undercut those recent lows.
What's the line on the bottom there? If we're looking at 5,400 or so at the top here, I know a lot of people have been talking about that 200-day moving average on the S&P, which we're still quite a bit of ways from. I think that's down around 5,000. But what's that line in the sand for you?
Yeah, look, we're less less so worried about the absolute number on the S&P. Really what we're looking for is on the internals, we want to see less than 20% of the S&P trade above their 20-day moving average. Typically, that's what you see at a minimum at durable lows. You kind of call that a breath washout. And Monday, even intraday at the lows on Monday, we only got down to around 28, 29%. We closed around 31%. So you really want to see that. Despite the fact that we had a decent drawdown from the highs on the index level, the internals, were not consistent. And we looked back, since 1990, we are hard pressed to find a 5% or more drawdown on the S&P that ended without seeing that internal breath washout. So that's really what we're monitoring. We could get down to the 200 moving average, but I think something in the 5,050 on 100 area would certainly get that washout at this point.
Okay, so then when we get to that, so how do we get to that level, I guess? What kind of volatility can we expect as we get there?
Yeah, I mean, look, I think it's not, I think the spot VIX print Monday at the highs, I think, as a lot of people have noted, it was a bit, superficial just with the way it was calculated. If you look at the VIX futures, they didn't get nearly as extreme as we saw it with spot VIX. So I don't think it's a stretch to say we're going to see a positive divergence in volatility, meaning price S&P probably goes lower, VIX, and even VIX futures probably do not see the highs they saw on Monday. That's pretty typical on retest lows. But I think it's going to be choppy. I think the reaction to the economic data is shifting, right? We have some inflation prints this week, but I think the market's shifting its focus from inflation to growth, and so retail sales and even jobless claims will probably be more important to the trading. So we're watching to see how that reacts, and then of course you have the intermarket analysis with the yen. We can't say whether that carry trade is done, but certainly the market's still reacting to big moves in dollar yen, so we're watching that as well.
All right, what do you do with the Russell here? It did bounce off its 200-day. We are now kind of sitting right below that 100-day. What do the technicals tell you there?
Yeah, so we when we got that breakout in mid-July, we said you can dance while the music's playing, but don't overstay your welcome, basically. And what we had was kind of a breakout through key resistance. We'll use the IWM, which was the resistance was 210 on IWM. Once we broke back below that, we're now saying small caps are guilty until proven innocent. So you have that false breakout potential until and unless IWM can reclaim 210. We'd be skeptical of rallies. You get above that, and we can have another conversation. But right now, it's looking like a bit of a false breakout.
When we talk about small caps, and obviously putting that into the context of economic conditions and the idea that people are trying to sort of, I guess, find that entry point into the cyclical trade, is there a counter trade to that right now, or nothing?
Yeah, I mean, I think it's interesting that obviously some of the defensives have been working, and REITs are actually really interesting to us. They've had a decent move, but if you put it in perspective, over the last 2 years, they're still the worst performing sector, down around 7% over the last 2 years. I think the fact that they're holding their breakout, unlike small caps, throughout the recent bout of volatility is encouraging. So you're seeing that relative performance to the S&P move higher. So we like REITs here. They're obviously rates sensitive, but they also can act as a little bit of a buffer in some volatility. I think that they're proving that right now.
All right, Jonathan, great stuff. Jonathan Krinsky, Chief Market Technician over at BTIG, helping us count you down to those closing bells. As far as the yields market goes here, interesting that the 10-year still around that 3.9 level here, and that 2-year yield right now kind of on the precipice of dipping below 4%. But you go back to the equity market here, and it's I mean, I guess you call it a sell-off. I mean, or more of it's just kind of a not buy-off, or I don't know what's
a not buying thingy.
Yeah, not buying thing is that's a technical term. Right?
It is a technical term. Yeah. But also, interestingly enough, you take a look at lower yields. Also, oil looks on the cusp of breaking out. Also, so I wonder how much of the action in the bond market as well as the commodity market is actually geopolitical risk instead, and the equity market more immune to that.
Well, this is the question I've been asking a lot of people on the phone, which is about the correlations, right? Because that's really going to cross-asset correlations, because we know those all kind of broke down earlier this year, and I wonder if they are kind of converging again, which might not actually be good for the market, depending on how scared you are.
Right, and for those couple days where we saw that big sell-off, it did look like correlations were picking back up, and then it came back down. So So that's going to be quite interesting if we do get sort of a resurgence in geopolitical risk in the Middle East.
Yeah, absolutely. Oh, God, the Middle East. Yeah, I forgot all about it. I thought you were talking about right here at home.
No, well, maybe. No, but for oil and bond market today, it's Iran and Israel now.
Yeah, I hear you. And then, of course, some undisturbing developments, of course, about the war in Ukraine over the weekend. So a lot for investors to chew on. And then, of course, you got a big political convention taking place here in the U.S. next week that could potentially reshape some people's perceptions of things. We break down all of your market action as we do every day around this time. Stick with us. Full market coverage coming up right now, right here on Bloomberg.
The Closing Bell, Bloomberg's comprehensive cross-platform coverage of the U.S. market close, starts right now.
And right now, we are 2 minutes away from the end of the trading day. Romaine Bostick here with Alex Teal, taking you to the closing bell. Here with help, it's our global simulcast. Scarlet Fu joining us in the television studio. Carol Masser.
I need help.
Still in the radio booth. Oh, God. Yeah, say it again. And Tim Stenovic, welcome back after a much-deserved time off as we welcome our audiences across all of our Bloomberg platforms. Tim, have you helped Carol out today?
She's helped me. I've helped her.
Yeah. Always.
Yeah, we're always looking out for each other.
Big assist. Really quiet day here, right? It's like we're waiting for maybe a couple of economic reports. Oh, yeah, we are. A couple of inflation reads and a read on retail, and then we got weekly jobless. So I feel like we're going to jump from data point to data point.
Yeah, CPI, PPI this week, certainly important ones. Not necessarily in that order. Let's go PPI, then CPI.
Nice.
And then next week, of course, Jackson Hole. And, while I was gone, I heard people were screaming about an emergency 75 basis point rate cut.
That's gone.
Yeah,
that's
there were
gone.
Some people.
Like I left for a week. I left for a week.
A couple of hours on Monday.
Crazy.
Yeah. What happened?
Nothing really, Tim.
Okay.
I mean, if you look at the price of where the S&P closed the day you left, you look at the price of it today, absolutely nothing happened.
Nothing happened.
There was a big freak out, and people have since calmed down. And right now, to Carol's point, there's a lot of anticipation before these big data points. You have volume in the S&P 500 off 25% from the 20-day average.
Yeah, Tim, you definitely picked a good week to go on vacation. I think the Citi was saying we're looking for about 1% move for the S&P on Wednesday, which would correspond to CPI day. So we'll see if we wind up getting that or picking up at all for the VIX.
All right, not a whole lot of price action today. Just a couple of S&P sectors in the green, but not enough to really elevate the index overall. And S&P 500, as we wait for these numbers to settle, is basically going to close out the day unchanged. The Dow Jones Industrial Average is decidedly lower by more than 100 points, or 0.3%. The Nasdaq Composite higher by 0.2%. And when we take a look at the small and mid-cap space, we did have meaningful moves lower. S&P 400 mid-caps down 0.7%. The Russell 2000, Carol, down 0.9%.
All right, back to the S&P 500 I go, and you've got most names in the index lower today. 340 names losing ground on this Monday. 160, Scarlett, to the upside.
Yeah, and with the S&P 500 unchanged, it's really interesting to see the breakdown in the sector groups, because you'll note that there's 11 sector groups and 8 of them are in the red. REITs, communication services, and consumer staples are the biggest decliners there. Technology is the main reason why the S&P 500 is unchanged. It's up 0.9%. Energy also holding up its end of the bargain, gaining about 0.5%. Utilities, which have become a favorite safe haven, up by just 0.2%.
All right, guys, to the individual gainers we go. NVIDIA, it's a top gainer on both the S&P 500 and NASDAQ 100 on this Monday, up about 4% here at the close today. B of A making it one of its top rebound stock picks, outlining why a rebound scenario makes sense for the semi sector. And if the semiconductor sector bounces back, NVIDIA stock looks like a good play. And he assumes a sector rebound. He says likely in the fourth quarter of the year. Seasonal headwinds could fade by then. And so let's not forget that NVIDIA does report earnings at the end of the month later on. So liking this name, and so we did see a pop in it. Starbucks also trading higher, though at its highs about 4.5% today, finishing the day with about a 2.6% gain. The Wall Street Journal reported that activist investor Starboard Value has taken a stake. Starbucks discussing a settlement with Elliott that would give the activist investor representation on the board. That, according to people familiar, Elliott in addition wants Starbucks to commit to reviewing its business in China. So that was definitely out there. I think I saw you guys talking about it earlier.
Did you know they were selling boba tea?
What's boba tea?
That's with the
boba tea with the
bubbles.
little
the bubbles. I don't get that.
The tapioca pearls or whatever.
It's a thing from Taiwan. It's taken off in the last couple of years.
My daughter loves it.
Kids love it.
Yeah. Well, it's sugar.
Adults too,
Yeah,
Tim.
exactly.
Boba.
Sugar.
Really?
Yeah, adults love it too.
Our producer Meredith says boba is the best. All right, so KeyCorp, that was your number one gainer in the S&P 500 today, folks, up about 9%. And we did see this after receiving a minority investment from Scotiabank. So definitely sending that one higher. All right, Tim.
Hey, there were some notable decliners today. Do you want to start with JetBlue? Shares just got slammed today, falling 21%, the biggest drop on record. This after JetBlue announced that it kicked off a $2.7 billion bond and loan sale backed by its loyalty program. JetBlue looking to raise reserves and fund general corporate purposes. Meanwhile, Moody's Ratings and S&P Global Ratings both downgraded the airline to one notch above CCC levels. The company did say it plans to sell $400 million of 5-year convertible notes to repurchase some of its convertibles due in 2026. This according to people familiar with the situation. Shares, again, down 21%, the biggest drop on record. Another notable decliner, B. Riley Financial, ticker RILY. Look at this, falling more than 50%. A new round of write-downs amid a widening U.S. investigation into whether it gave investors an accurate picture of its financial health. The SEC assessing whether B. Riley adequately disclosed the risks embedded in some of its assets. This according to people familiar with the matter. And finally, keep an eye on shares of DJT, Trump Media and Technology today. The former president is back on Twitter after many months away from the platform. He's also got a conversation tonight with none other than Elon Musk. The company did report earnings after the bell on Friday. They reported a net loss for the second quarter of $16.4 million and revenue of about $840,000. The market cap still $4.8 billion. I think many people would argue that it's not necessarily driven by fundamentals. The stock down by about 5% today.
Shocked. I tell you, shocked, Tim, not by fundamentals. I take a look at the bond market here. It actually is interesting. We are seeing a bid. Earlier this morning, it was a whole lot of nothing, but now seeing a bid, particularly in the front end. Yes, we have the economic data coming out this week, but we also have that geopolitical risk coming in as well. Headline after headline about potential Iran retaliation to Israel, U.S. moving ships into the area. So, there's that percolating potentially also in the bond market, guys.
Yeah, amazing to see all those 4% levels, right? Like if you go back a week ago, pretty wild. Yeah. All right, guys, one thing that certainly caught our attention, and this has to do with consumers, that they are increasingly concerned about falling behind on their bills. And then you've got delinquency expectations rising to the highest level since the onset of the pandemic. This is coming from the New York Federal Reserve Bank.
Okay, so let's talk numbers here. The average likelihood that consumers would miss a minimum debt payment in the next 3 months rose to 13.3%. It's the highest level going back to April of 2020. This according to the Fed. The survey released today, the Federal Reserve Bank of New York. The stress increased the most for people earning less than $50,000 a year and for those with a high school degree or less.
And this tracks with all the anecdotes we've gotten over earnings season with consumers not spending as much on traveling, on hotel stays, and on discretionary items this summer, certainly compared to last summer, which felt like a high watermark in terms of spending.
Yeah, and we'll get, of course, another read, I guess, when we get those University of Michigan sentiment data numbers later this week here. And I guess it gets to this idea here of what the real read is on the economy. Alex, is it really about the data or is it about how people feel?
Yep, and it's K-shaped, right? So if it's K-shaped, then how do you deal with that if you're the Federal Reserve and dealing with sentiment and also the data when one area is doing poorly and one area is doing really well, as Scarlett will tell you in this next segment.
Very nice segue, Alex Steele. There's a good story on the Bloomberg.
She knew it was coming.
Yeah, exactly. About how certain home buyers are picking up some property, some seafront property, beachfront property in places where water is rising and their property may not even be around in 5 years' time as long as the water level is rising. You can buy a Cape Cod house for, get this, $395,000 compared to what it was selling for initially, which was $1.195 million in 2022.
Wow.
Yeah.
That is a serious discount.
Yes.
But there's a catch.
Well, I guess that's the question is, how much does it cost to insure it?
Well, it actually costs more, definitely, but is it going to be there? Is a bigger issue.
$1.6 million to insure. I thought it was an interesting story because I had a family member who did something similar, bought a coastal home, someone who's in retirement age, and it was the same attitude, which was like, you know what, by the time this thing washes offshore, I'll be long gone, and it's somebody else's problem then. So yeah, I guess so.
Yeah, well, I mean, this
Yeah.
is what this guy that's profiled in the story, right? He's like, life's too short. So what if it's gone in 10 years? I'll have 10 years of a beachfront property that I couldn't have afforded otherwise. It's pretty wild. But it says something more broadly about what's going on in terms of climate change.
Yeah, Nantucket, an island that's known for multi-million-dollar compounds. There was a seaside house sold in June for just $200,000. That's just a tenth of its assessed valuation. So the likely, market valuation, if it weren't about to wash away, would be much
so they
higher.
say they still got to pay the taxes on the $2 million.
They still have to pay the taxes, but you can't get a loan on these things, right? You can only pay cash for these homes because no bank is going to underwrite this loan.
I just feel like this is a perfect example of the two stories we just talked about. Like one story is about how consumers have revolving credit and there's worries about delinquency. Another one is like, hey, let's drop $200,000. It's a really big deal. I mean, it's a great deal compared to over $1 million. Let's do it and stay there for 10 years.
K-shaped, right? Where's Peter Atwater when we need him, right? Like, it says so much. All right, guys, that's a wrap. Our cross-platform coverage, radio, TV, YouTube, Bloomberg Originals. We will see you again. Alex is heading out. Scarlett and Romain continuing on TV. And Tim and I are going to get back to work here on Business Week on Bloomberg Radio. But we will all see you same time, same place tomorrow.
All right, stick with us. A lot more coming up here on the big program. The head of global fixed income over at Morgan Stanley Investment Management going to be joining us in just a second. This is Bloomberg.
Welcome back to The Close. I'm Scarlett Fu.
And I'm Romain Bostic. We talk about the big sell-off and rally that we had last week.
What sell-off?
I don't know what you call it today here, but, well, just take a look at the screen behind me. Unchanged on the S&P 500. Kind of fitting given the price action that we saw today. Very tepid here. Volume light here on this summer Monday in the middle of August here. And then you saw, though, a bit of a rebound, though, in the tech stocks. That actually did continue, believe it or not, at least as far as the XLK is concerned. Third straight day of gains. So people are coming back into some of those big cap tech names, particularly names like NVIDIA. What you're not seeing, though, are people come back into that small cap space. So Russell 2000 now down once again here. And this is now the 8th straight session where the Russell has underperformed the broader market, a complete flip-flop of the trend line that we had seen in the days and weeks prior. And if there's any concern here, any nervousness here about economic conditions, take a look at gold. You're looking at 24.72, Scarlett. That's a record high.
Yeah,
and people don't buy gold when they're feeling good.
So don't get fooled by the S&P 500 being unchanged is the other way of putting it. All right, there are a couple of idiosyncratic equity movers I want to focus on here. JetBlue falling by the most ever, losing 21% on the day. Moody's and S&P downgrading the airliner deeper into junk territory. It is now just one notch above CCC levels. The moves follow JetBlue's announcement that it is starting a $2.75 billion debt sale that is backed by its loyalty program, the True Blue Points. We also have Hawaiian Electric losing almost 15% on the day, the utility plunging the most in almost a year after issuing a going concern warning. This is continued fallout from the wildfires last year in Maui that, of course, killed dozens of people and basically destroyed the town of Lahaina. The company pegged losses from that disaster at $1.7 billion. So just a roundup of a couple of names that really stuck out in trading today. But our top story this hour is the great volatility spike of 2024 is over, at least for now. When you look at the VIX dipping below 19 today versus the 65 that it touched last Monday, it really reflects the calm that seems to have been restored after last week's global market meltdown. Although most of 2024 has been marked by a steady melt up in asset prices, especially risk assets, investors are increasingly demanding ways to trade volatility. We're going to speak with the Cboe Global Head of Derivatives to learn more about new products that are coming just in time for the November elections. Romain?
Oh, yeah, can't wait for that. For the November election, Scarlett. I don't know. I'm just trying to get through the next week here. Let's keep it going here because there has been a lot of discussion about what really drove that sell-off, what drove the rebound, and maybe, I guess, what pushes the market in the next direction next. Brian Weinstein joining us right now, head of global markets at Morgan Stanley Investment Management. And look, I know you don't actually know exactly where the market is going to go next, but when you look at the price action, and let's just go all the way back kind of the start of July, because that seemed to be when things really kind of started to change a little bit here. what is changing, or what are investors trying to reprice?
I think investors are trying to reprice the Fed and their reaction function. And I think the Fed has done a relatively poor job of advancing the story. So what happened here, I think, is that the economy is definitely getting weaker in spots. I heard you before. Parts are okay, parts are not. And the parts that are not, I think it requires a calibration of Fed funds rate away from being very restrictive. And the Fed keeps saying, well, look at the next CPI. Well, no, that's not going to work anymore. So when you get some volatility, you get geopolitical, you get election, and a little bit of deleveraging, you get a big move. So I'm not sure exactly why it happened, but I do think you need to reframe this, and the Fed needs to come, not do an emergency rate cut, but advance the story.
You aren't one of those people like crossover.
You don't go from, I'm not going to do it. That was not emergency rate cut territory. Thank goodness.
I am curious, though, about whether the Fed has lost the narrative, because it seems like during this sort of 1 year plus pause, they kind of did have control of the narrative. I know there was some pushback to the market, but that was always short-lived, a day or two. This seems different.
I think it is.
Yeah.
I think what happened is, as the Fed started to change last December, the market got really far ahead and financial conditions eased. So credit spreads did well, and they kind of felt like they couldn't actually ease. But again, easing is going to help a little bit that weaker part of the economy. And again, inflation going to 8 and 9%, that's why we had a 5.5% Fed funds rate. Inflation going back between 2 and 3, you don't need to go back to 2% Fed funds, but you have to lower from 5.5. So I think they fought a little too hard against that initial ease. They could have gone a couple weeks ago, but it's coming now.
And I was looking at the differential, Scarlett, between where inflation is and where that Fed funds rate is. It's a pretty huge, one of the biggest gaps we've seen
that's notable.
in the modern era.
Brian, I'm curious, what was last Monday like for you, and how has it changed since then? What are the calls like today?
Yeah, I mean, listen, last Monday is one of those days that you remember, right? I've lived through any number of them, many much worse than that one. But, you know, it's a good reminder that complacency is where markets take you, right? Over time, everyone ends up in the same trades. Whenever it seems easy, right? That's why that's why people like to hedge a little bit or keep some cash. So last Monday, listen, I wouldn't have expected the VIX to go to 60, right? That one I still have really no great answer for. But for treasuries to rally, makes sense, right? It's a flight to quality. For the biggest movers of the year to all go down at the same time, sure, they're all correlated. What do I think it means longer term? Listen, I think the flight to quality in treasuries is the one that's going to have the hardest problem, because the Fed will calibrate. Inflation will not fall below 2%. The government will continue to spend. There will continue to be plenty of debt for people to buy. So I think the front end makes sense. I think where people are going to wish they didn't spend a lot of their cash was moving out the yield curve in duration. I think that is the part that's been mispriced in this move. It'll take a little bit to unwind, but there's plenty of geopolitical to go around for now. But listen, I think what you learn is that you have to have your portfolio positioned the way you want it 6 months from now, because you might not get the day you want to move your portfolio may not be a very good day to do it.
Right, exactly. And you don't want to be forced into doing so. You mentioned unwinding. Are we still seeing the unwinding of the yen carry trade, or has that been completed?
Listen, I think you'll still see it, right? And it'll come in waves. The Bank of Japan's in a very tough spot, right? I mean, versus the Fed. They don't want to be where they are. They want interest rates to go up in an orderly fashion and the currency to revalue in an orderly fashion. I don't think they can get both, right? So there has to be a pressure release valve. So they tried the currency. That was pretty ugly. Maybe they'll stabilize that and end up being their bond market. But listen, I do think there'll be more people willing to take profits as we go back towards the highs than there were before Monday.
How much do you take the deputy governor at his word? Because that's not the governor speaking. So therefore, on what authority is he speaking?
Well, I think it's pretty clear that central banks don't raise rates to days like Monday, right? So I don't think it was a nice statement, probably a throwaway statement. Okay. But they have to continue to normalize their policy, right? They can't keep buying every bond, every stock, right, keeping rates near zero. Yeah, I think that statement was a wise statement in the terms of course, you don't raise rates on days like Monday, and you don't want disorder. So a nice statement, but I don't know that I would read much more into it than that.
Yeah, it'll be interesting to see too, particularly if the Fed does start that rate cutting cycle, how that is going to affect the psyche when it comes to that going forward. I do want to bring it back here to the U.S. and particularly the competition that we started to see in the fixed income space, kind of within it. We were speaking with Sonali Pier over at Pimco a little bit earlier. She was kind of extolling the virtues of corporate credit over treasuries, which of course is what she should be doing because that's her job. But she made a pretty good argument as to why it offers potentially better value now than going into treasuries?
Listen, I like investment-grade credit. I think the story there is good. Or maybe said differently, I think the treasury story is bad, right? I can see a lot of reasons why investment-grade credit could revisit and go back through the tights. I'm less sure about high yield, right? The Fed easing, calibrating in the economy, a bad fiscal situation, an unbalanced economy, those could go either way for high yield. When it got close to 300, historically it struggled there. Investment-grade credit widened a decent amount with this rally, and I do think there's a case to be made for investors owning a bit more investment grade and a little bit less of U.S. Treasuries. Listen, there'll be days like Monday where you regret it. There's no question. But over the long term, I think the Treasury market is where a lot of the problems are going to develop versus the corporate bond market.
So you're not concerned about any kind of spread blowout, at least not on a more permanent, prolonged basis?
We know, and Monday was a good reminder that if the Treasury market rallies 45 basis points overnight, credit will be wider. But in terms of, do I think that's the long-term play? This is the end of the rally for credit? I don't. I think credit's okay.
When you looked at what happened last week and kind of, I guess, let's just say over the last 8 to 10 sessions here, was that indicative of a healthy market? Do you think we're getting fair price discovery right now?
Listen, I think when you have those days and people do start to move around bonds that haven't moved around for a while, it'll take a couple days. So where high yield spreads really 75, 100 wider, well, really prices didn't move and treasuries rallied. But what you see as soon as there was a moment of calm, buyers. Right? And so, I do think there is a demand for yield. I do think that there will be continued demand for credit, and steeper yield curves are in our future, and all the things with the fiscal deficit are going to. We have years and years to talk about it. These don't happen overnight. So yes, I think in some ways there's a healthy price discovery that comes with Monday when people need to move their portfolios around, not the day of, but in the days that follow.
Do you think the violent drawdown that we saw last Monday changed market psychology in a meaningful way as we await CPI, PPI, and retail sales?
I like to think that it did, but I think only a little bit, right? I think what we really need is the Fed to change the story. So is Wednesday's CPI important? Sure, it's important. Is it the most important data point of the week? I don't think so, right? We know how CPI moves. We know it kind of moves in waves. We know it's come off the highs, and we're printing these kind of 0.2s, which is where the Fed needs it to be. I'm more worried about retail sales, right? Or jobless claims and the big jobs numbers. It's a question of not where was CPI a couple months ago when this number was pretty much baked in the cake. It's a question of what do we look like forward? If we've destroyed demand, inflation will fall, right? And it feels like that's what we've done to some degree.
All right, well, we'll see how that all shakes out. Retail sales is the big report then on Thursday. Brian Weinstein, head of global markets at Morgan Stanley Investment Management. And, Romain, the anecdotal from companies reporting earnings is really not encouraging on that front when it comes to retail sales or the jobs picture.
No, we've seen that. We were talking last week. Of course, we got some of the restaurant names. We were talking today about KFC kind of going more value. You're seeing that in restaurants. We've heard it from some apparel makers already.
The travel companies?
I'm really curious to see what Walmart has to say, because in theory, they would be a beneficiary of this. But even if you remember last quarter, they talked about how they're actually feeling the same pinch to a certain extent, that more people are coming into their stores looking for bargains, but that doesn't necessarily mean they're spending more.
Right, exactly. Or they're finding the bargains that they're willing to spend on.
Yeah, exactly.
There you go. It continues.
How much time did you spend in Costco this weekend? I know you're a Costco.
I did spend a lot of time.
Aren't you like an admiral? What are you, an admiral?
I'm an executive member.
Executive?
Yes.
Wow.
Yeah. No, they're double checking everyone's membership too now.
I heard. So
like
now I can't just sneak in behind you.
No, you can't
anymore.
pretend to be me and go to the self-checkout line anymore. All right, we're going to have to discuss your backup plan. Coming up, we've got the top three, where we focus in on the top three movers and shakers at the center of the day's biggest stories. This is The Close on Bloomberg.
Season is here.
You're seeing back-to-back billion-dollar-plus quarters.
The forward indicators were so positive.
Bloomberg is first to break the numbers.
Texas Instruments out, folks.
Goldman Sachs taking a look at Mattel.
There is something for everybody.
With the smartest insights.
People are whitewashing AI.
Wallets are under pressure.
We are committed to EVs. They're going to happen.
Earnings season in full swing.
We will have full and instant analysis.
Continuing coverage on Bloomberg. Context changes everything.
It's time now for the top three, where we name drop the people driving some of the day's most talked about stories. And first up is Jordan Chiles, the gymnast who's at the center of a standoff between the International Olympics Committee and the U.S. So she was awarded the bronze medal after successfully challenging her initial score. This is in the individual events. But now the IOC is saying Chiles' team submitted the challenge after the 1 minute deadline had passed. So now they want her to give up the bronze medal, and they're going to award the bronze medal to a Romanian gymnast.
So sadly, this is actually way more common than people realize. He's sort of judging score changes after the fact. But it's just kind of, I read something in the New York Times. So I'm going to source the New York Times.
Go ahead.
That apparently Romania and some of the other countries involved in this had proposed that all three of them get the bronze as sort of a compromise. And the IOC was basically, nah, that's not happening.
We don't play that
We're
game.
only going to give it to one. So the countries actually tried to do something that was diplomatic and fair. And then the IOC basically said, no, sorry, Jordan, you got to give it up. And Romania gets it.
But the high jumpers, they awarded 2 gold medals.
Yeah, I don't know about the high jumpers. That's like
the Italian and the American, I believe, or the Kenyan. I'm sorry, I can't remember off the top of my head.
Well,
but
Jordan Giles is still a medalist in our hearts.
And she's home with her medal, by the way.
That's right. All right, someone else I'm keeping an eye on is Nadine Ahn. You probably haven't heard of her, but she was a big deal over at RBC. She got promoted to CFO back in 2021. And then she got fired earlier this year. There were some concerns about a personal relationship that she had with a colleague that apparently wasn't disclosed properly. But what's interesting here, there's lawsuits, and what we're learning in the lawsuit was apparently she was in line to be CEO. At least, again, that's according to her and what she's putting in there. And that's part of her grievance here is that she's missing out on potentially a huge payday by being fired for something that at least she thinks is unfair.
Yeah, she was accused of this undisclosed close personal relationship that they say led to preferential treatment of that person, including promotion and raises. She was fired. The other person was fired as well. So now they're both suing for wrongful dismissal. Yeah. So it's a kind of sad story here. It'll be interesting to see how that plays out for Nadine and Royal Bank of Canada. All right. Finally, the last person we're watching is Susan Wojcicki. She is the internet pioneer at Google and YouTube. She died over the weekend following a 2-year battle with cancer. She was 56 years old. The longtime head of YouTube, often referred to as the godmother of Google, because she was the 16th employee and put into place a lot of the policy and decisions that the company later, embraced as part of its culture. Yeah, so many great anecdotal stories about her, including the fact that, of course, the founders of the company were using her garage, renting her garage when they were starting up the company, which is how she met them. And of course, we always talk about how a lot of these companies, they need sort of an adult in the room. For a lot of years, she was that adult in the room. She'll certainly be missed, not just by her family, but by her employees and investors alike. All right, let's take a look back in history. On this day, back in 1992, the leaders of the U.S., Canada, and Mexico announced that they had completed a draft version of NAFTA, an economic agreement that would form the largest free trade zone in history, encompassing at least 370 million people and GDP of at least $6.5 trillion at the time. Now, for the U.S., the North American Free Trade Agreement meant about half of all of its exports to Mexico. That includes chips, computers, telecom equipment, medical devices, all duty-free immediately, and tariffs on almost all the other goods were phased out over the following 10 years. Now, while that deal had tangible benefits for the U.S. and Canada, Mexico was largely seen as the biggest beneficiary, particularly because of provisions that opened up Mexico's financial services industry. But NAFTA was and has remained controversial from the early seeds of a trilateral trade zone idea planted by Ronald Reagan to the implementation under President Bill Clinton to the renegotiation of the deal under President Trump. Many labor organizations opposed the agreement because of the fear that manufacturers would move to Mexico. In fact, in 1992, presidential candidate Ross Perot famously warned of that giant sucking sound of American jobs moving south. And in a rebuttal in 1993, Vice President Al Gore gave Perot a picture of the architects of the 1930 Smoot-Hawley Tariff Act and warned against following a similar path of U.S. protectionism. But the concerns raised by the unions, raised by Perot, raised by others were somewhat, founded. The U.S. had been running small but persistent trade surpluses with Mexico for years, including a $1.7 billion surplus back in 1993. Now, how much did the U.S. trade deficit with Mexico widen in those first 2 years of NAFTA's existence? By the end of 1995, that surplus had flipped to a deficit of more than $15 billion. And as of last year, that trade gap had widened to $152 billion, second only to our deficit with China. Now, economists still argue over the impact of that, with studies showing it didn't actually cause major aggregate job losses. But you know what? It also didn't significantly boost GDP.
And after years of hand-wringing, a massive renegotiated deal took effect back in July 2020. And even today, back in here in 2024, NAFTA still remains a hot-button political issue. Scarlett?
Yeah, it's no wonder when you look at ECTR, the trade flow function on the Bloomberg. Mexico and Canada make up the biggest trade partners of the U.S., with China a distant third. Mexico, $746 billion, Canada, $713 billion on an annual basis, or at least as of 2023. All right, let's stick with politics here, because Elon Musk and Donald Trump are slated to sit down for an interview on X tonight. It'll be the first public interaction between the two since the Tesla CEO endorsed Trump last month. Here now in studio with more on this is Bloomberg Balance of Power co-host Joe Mathieu. Joe, didn't Elon Musk host a conversation with another presidential contender not so long ago that didn't go too well? People couldn't hear half of it.
You remember the feedback and all the coughing? You couldn't place some of the voices. That was Ron DeSantis. That was, in fact, his campaign launch, which made a lot of people wonder exactly how well things were working behind the scenes. And here we go again. Yes, it's going to be Elon Musk who says he's scaling up. I guess they're adding a bunch of servers to this. But that was a great piece, Romaine, and it really makes us think about how much the Republican Party approach to so many things have changed. This is now the party of tariffs. It's the party of a higher minimum wage. If you ask J.D. Vance, it's a higher child tax credit that J.D. Vance was shopping on Sunday morning. This is not your grandfather's Republican
Well, that's
Party.
what I'm curious about, too. And this is probably going to be a dumb question, but are we going to hear any sort of articulation of some of the policies surrounding some of those issues? Because so much of this campaign so far seems to be much more, I guess, personal, if you will, and much more about culture wars. But I don't really hear how we're going to address some of these trade, immigration, and other issues.
These are great questions, and that's been the knock on Kamala Harris, right? What are the proposals? What's your platform? Donald Trump could go a long way to detailing a lot of his ideas as well. I don't know. Is this a policy discussion, or is this just kind of another meeting of the personalities here? This is a show business event, isn't it? But it's also someone who's putting millions of dollars a month into the Trump campaign.
Although he says he's not going to necessarily give the $45 million that he initially promised,
Might not be 45, but he's been giving them money, and this isn't exactly what you'd call an interview from the schools that we come from.
Yeah, no kidding. I don't think there's going to be any fact-checking for this interview necessarily. You mentioned Kamala Harris, and she is tapping donors in San Francisco. She is on this big swing state tour. Have we gotten more detail from her on policy, or is it kind of the same campaign stump speech she's been giving?
It's been more of the latter, and that's why we're all asking that, right? Whether there's going to be a news conference or a hard-hitting interview, I wouldn't hold your breath for that before the convention. We're all going to Chicago next week, which is going to be the coronation and the rah-rah. And it's, a campaign that made another $12 million at a fundraiser in San Francisco last week. Are normal people asking for an interview? Because she seems to be resonating on Instagram, on Twitter, with fundraisers, with young people. There's a new poll out today from one of the PACs following her, but it's run by the person who runs the Harvard School of Politics here as their pollster, John Della Volpe, finding an enormous jump in 18 to 29-year-olds, young people who didn't care about this campaign before now.
Yeah, and that raises the question, Joe, does she need the traditional media like us? I mean, we've gotten to a point. We saw how Trump won back in 2016, largely on the back of a big social media push.
Just go on Instagram.
You can check Joe Mathieu at the top of the hour on Balance of Power alongside Kaylee Lines here as we continue to focus on the horse race, of course, that will be decided in November. But as we work towards that, there's going to be a lot of volatility in the market as, of course, investors trying to figure out not just who wins, but more importantly, what the impact could potentially be on the markets. Catherine Clay is joining us right now. She's the global head of derivatives over at Cboe Global Markets, joining us from, of course, the greatest city in the world, Chicago, Illinois. And Catherine, I do want to start off with volatility. We got a kind of a taste of that these last couple of weeks. Of course, that had less to do with the election and more to do with a lot of other factors here. But based on what you're seeing, should investors kind of prepare themselves for an increase in volatility as we get into September, October, and November?
Nice to be here. Thanks for having me. I would agree with you that investors should be looking at the volatility landscape. But I would also argue that, in fact, they have been looking at the volatility landscape for a while now. In fact, as I looked at what the open interest numbers were in VIX options heading into August this year, there's over 15 million contracts. And you contrast that with this time last year, it was just above 12 million contracts. So we're already seeing in our SPX options, in our VIX options and VIX futures, this additional hedging and exposures to portfolios that actually give them a bit of a buffer that really is a utility for times like these, and even going back a week from today, those that had those embedded options, those futures in their portfolios, were able to react a little bit differently than those that didn't have those in their portfolio. So we look at this as a very good toolkit into an election with geopolitical tensions around the world. These are just really useful investments to make in your portfolio.
And I assume that that number of open contracts is just going to increase steadily as we get closer to the election?
Well, one can't guess, but I wouldn't be surprised if we see additional hedging into this event. I think last Monday's event gives people a little bit of a shock about, is that yen carry trade actually closed down? How much more does it have to go? It invited a little bit more uncertainty. And when uncertainty hits the marketplace, we tend to see investors and traders taking ownership of more of these types of convexity options like the VIX options, moving into protective positions in the SPX options. So I wouldn't be surprised as the elections loom to see a little bit more of that hedging activity.
And of course, you are expanding your VIX product suite as well as we head towards November. Walk us through exactly what you're offering and what it'll enable investors to do that they can't do right now.
Yeah, that's a great question, and thank you for asking that, because next month we will be relaunching a variance future into our volatility toolkit, which is really a unique way to express a volatility perspective or to hedge some of that volatility that you have in your portfolio. And maybe even more meaningfully later in the year, we will be bringing options on VIX futures. Now, you may say, well, you already have VIX options, so what is this flavor of options on VIX futures? They have similar traits, but they also have some different and important characteristics. I think the most important difference is that these options on VIX futures will be able to be held in futures accounts. Contrasting that with the VIX options we have today are held in securities accounts. So we think this opens up just enormous new access for investors who heretofore haven't been able to really access that great tool in their portfolio. And so VIX options on futures, we think, is going to provide that nice little niche for those futures accounts.
And volatility is increasingly seen as its own asset class as well. Compare and contrast the demand you have for volatility products from institutional investors, from traders, versus those who are retail investors and, who have obviously taken a big liking to options on individual companies, individual stocks.
Well, if you look at SPX, which we view as obviously a hedging mechanism, as well as other utilities, you do see high retail participation in the SPX index options that we offer. You see lesser participation in the VIX options. And of course, when you get out to things like variance, that's much more of an institutional product. And I would note last week, when we had all of the volatility in the marketplace, we did in fact see more institutional volume come into the marketplace as they're trying to hedge much larger portfolios. But I do think having options on VIX futures does open up this ability for retail traders to even start enacting with this product through their futures accounts. So much more on the institutional side volatility, but I think because VIX is so widely known and because its benefits are being much more understood by all market segments, I do think that the retail traders will provide, find some utility in these options, whether they're in the securities accounts or on the futures side. And as well on the futures side, we're actually going to be adding shorter duration expiries, so to give you that sort of 1 day to 5 day ability to trade in these options, which the VIX options today don't have.
On the retail side, with the uptake of these new types of products, does that mainly come from the individual investor, him or herself, or are you seeing maybe some of that activity being pushed through the sort of advisory pipeline onto the investor?
I think in general, what has really fueled the rapid rise with the retail trader and options in general has just been education, education, education. And that could be education that comes from exchanges like our Options Institute. It could come from the retail broker-dealers themselves. And certainly it comes from a wide swath of educators who also have students that are learning how to trade appropriately in the marketplace. So I think it's just this broader tailwind that we're riding of more education, better use of strategies, understanding how to get in and out of the market safely, when to take your profits, no naked selling unless there's an absolute good reason for it. And so come back day in and day out. We don't want churn in the industry. Retail broker dealers don't want churn. It takes them a lot of time and money to get the clients on their platform. We, of course, want people to smartly engage in our market. So I really think the underpinning answer to all of that is all the education that really happened kind of pandemic and then beyond.
I want to ask you, Catherine, a question. It's a little bit kind of to the left of all this, and it really just kind of has to do with the role of market makers. I mean, given your background and, of course, given what Cboe does here, and given all the volatility we've seen in the market, we've seen kind of the importance of market makers, particularly human market makers, meaning those that aren't just relying on the computers fully here, sort of rise in importance as a lot of people are looking for things that maybe are a little bit more bespoke or just want a little bit more of a high touch. Are you finding that flowing through Cboe, or is that something that's maybe divorced from what you're doing?
Well, I'm sitting here. The market is closed, but I am sitting on our trading floor, which is a very vibrant trading floor during real-time market hours. And you're spot on, Romaine, that the utility that this trading floor brings to the price discovery, to the matching of buy-sell orders in times of systemic risk and times of volatility cannot be overstated. It's very difficult for the market makers that stand in this crowd day in and day out, not give a market when they're asked to respond to a market. It's much easier to potentially disappear on the electronic quote side. But really, when you're standing in the pit and you're asked to provide liquidity, it really does provide, that utility of liquidity and price formation. And I don't think it's any surprise that given the fact that we have this vibrant floor, the S&P equity index option complex is the most liquid and strongest derivatives market in the world.
Well, speaking of liquidity, just a quick final question for you, Catherine, about VIX going to 65 last Monday. That was at 8 in the morning before the cash market had opened. Do you think that VIX could have gotten to 65 during the cash hours?
It's difficult to say, but we know that the VIX calculation adheres to a strict VIX methodology document. We're not talking that this is Kentucky Fried Chicken's secret recipe of 12 herbs and spices. This is a detailed, transparent document for anyone to see about how the VIX gets calculated. So in those moments when markets might go wide, there is a smoothing algorithm in that methodology document that gives a guidance to exactly how we're calculating that VIX. I actually had people come to me and say, I'm surprised, given the landscape out of Japan especially, that the VIX didn't spike higher. Well, the good news is nobody has to intuit what that value is going to be. It's right there in the methodology document, and there was no problem with the plumbing. It struck exactly as the methodology said it would.
All right, Catherine, really appreciate your joining us to give us a breakdown here of the volatility products that the Cboe has in the pipeline for investors and traders. Catherine Clay is Global Head of Derivatives at Cboe Global Markets. And taking a look at how markets closed on the day, a big fat unchanged for the S&P 500. It was up, it was down, but it finished little change. Clearly, investors in wait-and-see mode remain as the VIX holds at around 20 for PPI, CPI, and retail sales this week.
Yeah, and a few earnings sandwiched in between. This is the close on Bloomberg.
A week full of retail earnings kicks off tomorrow when Home Depot reports before the bell. Bloomberg Intelligence expects comp sales to shrink for a seventh straight quarter. Stephen Zaccone is Director of Equity Research at Citigroup Global Markets, and he joins us now. So, Stephen, 7 straight quarters of lower comp sales is not exactly the stuff that investors get really excited about. What could save this quarter? Is it the professional segment that kind of kicks things into gear?
Yeah, thanks for having me on, Scarlett. I think this quarter is going to be a continuation of slightly weaker than expected trends. The opportunity for Home Depot is really about that pivot to growth as we get into the back half of this year and more likely 2025. Rate cuts are really what matter here. The housing market has been essentially frozen when it comes to housing turnover. We really need rate cuts to happen to get that large project spend to come back and general repair and remodel activity to come back. That's really what's missing to that pivot to growth.
How fast, though, do you see that impact? Let's say the Fed does start that rate cutting cycle this year here. When does something like that sort of feed through into Home Depot's sales and earnings?
Yeah, it's a good question. And it's the key unknown, because I think if we get a rate cut in September, as our city economists are calling for, we could start to see some recovery on a 3-month lag. More likely, it's probably a 2025 event. So you're talking about a 3 to 6 month lag. But the opportunity is really, there's a good amount of deferred demand that's just waiting to kind of get back into the market. We've seen a lot of small maintenance projects. That's really been the big theme for the past year and a half. But we really need rate cuts to happen to see those large project remodels. Think kitchen, bath, flooring remodels. We have another company we cover, Floor and Decor, has really been the most challenged by this. But for Depot, you need some of those large project activity to happen again.
So does Home Depot rely more on actual transactions of property purchases, or can it rely enough on people who are just making improvements to their homes, or has that kind of been taken away because of the pandemic not so long ago?
Yeah, I mean, we're still anniversarying some really big sales that we saw in 2020 and 2021. So the last couple of years have been a give back of some of those strong performance. We've also had to deal with the wallet share shift, right? You and I have been traveling much more versus spending on our home. So, I mean, those have been factors that Home Depot would tell you have been the bigger issues at play, right? So I think as we move forward, you need a healthy consumer first and foremost, right? Jobs picture is something to monitor. Secondly, we have had home price appreciation. So as much as we've had a frozen housing market, we have had home prices moving in the right direction to support that return on investment of investing in your home. I think now you just need that movement. You really need people to start moving again and turning over properties. That's really the missing piece and the pivot to growth. In terms of, that's really the big driver of transactions. When you think about the other side of the equation in ticket, this is a rational pricing industry.
Yeah.
We've seen some level of disinflation. Maybe some elements of the business have seen deflation, but you're not really going to see this category get super promotional, right? This isn't apparel, so I'd say pricing is probably something you can rest your hat on. You really just need to see engagement back in the category.
And this gets to the broader question, though, Stephen, just about the health of the consumer. I know for some people, remodels and things like that are more necessity than discretionary. But at the end of the day, if you're not feeling good about the economy or you don't have a job, you're not doing any major projects.
Yeah, and I think you hit it. I mean, that's been the theme year to date, right? Like the consumer is still pretty solid, but they're showing more cracks. They're weakening. They're dealing with the higher credit card balances. They're dealing with the lag effect of just like rates being higher for longer, the lag effect of inflation catching up to them. What we've seen is it's been most pronounced in the low income consumer. When you think Home Depot, you're definitely more exposed to middle to upper income. That's more the homeowner across the U.S. So they're a bit more insulated. But you're right. I mean, consumer confidence has been an issue. When you think about the election, that's a big distraction.
Yeah.
You could argue the distraction has been pulled forward by the debate earlier than expected, and then obviously President Biden stepping out of the race. So I think that's been a big distraction, and it's been on the mind of the consumer. But as we look over the balance of the year, the election's still a distraction. Watching to see what the Fed does. I think that really is still what drives a lot of the focus for the consumer.
All right, Stephen, got to leave it there. Great stuff. Director of Equity Research over at Citigroup. A preview of those earnings out of Home Depot, scheduled to hit the tape before the bell tomorrow. We're going to set you up for some of the other potentially market-moving events over the next 24 hours when we come back. This is The Close on Bloomberg. All right, here are some of the potentially market-moving events over the next 24 hours. Elon Musk, Donald Trump in a cage match tonight. Who you got?
Cage match. Well, Elon Musk says that it will be unscripted. There will be no limits, so this should be interesting.
Before the bell tomorrow, we get earnings, Home Depot and On Holding. Who you got?
The sneaker maker. That's going to get all the attention because it's taking market share from Nike.
Yeah. Wow. And you love your shoes, right? Are you loving those? All right.
I like them.
We get economic data tomorrow as well. PPI and the NFIB Small Business Optimism Indicator. Who you got?
PPI is the big one. It's a lead up to CPI. Da, 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 da.
Oh, yeah. Absolutely. Yeah. And Google actually holding an event tomorrow to launch its latest Google devices. You have a Google device?
No, I don't have it.
Yeah, I don't think
I'm part of
anyone
the
does.
Apple ecosystem.
Yeah, well, maybe they'll change that tomorrow. And we get more Fed speak. Raphael Bostic, of course, the second best Bostic in the world, scheduled to speak tomorrow. We'll have full coverage right here on The Close with me and Scarlett. But stick around, all your politics coverage coming up at the top of the hour with Balance of Power.